All right, everybody, welcome to Chapter 10, where we're going to talk about financial markets. Now, this is going to be related to business and a little bit of personal information as well. This is a very in-depth chapter, and it's mostly a broad overview of things that you'll learn later on in your degree when you take more finance-related courses. But first off, we need to know the role of financial markets and the key players, right? So, financial markets, let's start there. Financial markets are markets that transfer funds from savers to borrowers. They perform a vital function of putting money into our hands as the consumers. Essentially, they're transferring money around to all parties. So it's benefiting both companies, it's benefiting consumers, and everybody overall benefits, right? Who loves having money? I'll tell you, I certainly do. So, understanding financial markets will benefit you from an individual and a business perspective. Think about this. If you were to invest $3,000 into the stock market without any additional funds, your money would grow to around $352,000 at the end of 50 years. And if you actually contributed $3,000 annually, you'd actually end up with around $3.8 million. Now, that's dependent on how well the stock market does or does not do and what happens at that time. But it's pretty crazy to think that if you're able to truly capitalize on the stock market, you could really benefit. So, let's talk about some institutions. Let's start with something called depository institutions, which are financial intermediaries that obtain funds by accepting checking and savings deposits from individuals, businesses, and other institutions, and then lending those funds to borrowers again. So they're a little bit of an intermediary, financial intermediary. Most common depository institution are something that we've probably all used before, banks. This is because you deposit money. That's why it's a depository institution. Easiest way to remember is, do you deposit there, right? Banks, you deposit. Same thing with credit unions. The only difference is that credit unions are owned by the depositors, but essentially it's just a bank. As well as savings and loan institutions, which are depository institutions that traditionally have been obtained most of its funds by accepting savings deposits, which have been used primarily for mortgage loans and things like that. But it's good to know about them regardless, right? Because all that stuff, as we know up to this point, impacts business. Even if you think there's no way it relates to business, it can guarantee it definitely does in some capacities. So that leads us to non-depository financial institutions. So in addition to banks and other institutions that we just talked about, we also have a number of other non-depository financial institutions. So we have a couple different that we're going to talk about. First off, institutional investors. They don't accept deposits, but they amass large pools of financial capital from other sources. Then they use those funds to acquire a portfolio of many different assets, right? So a couple examples would be mutual funds, where they obtain money by selling shares to investors; insurance companies, which they obtain money by collecting premiums from policyholders; and retirement funds, which obtain money by collecting funds from employers and their employees contribute for employee retirement. Up next, you have security brokers, which are financial intermediaries who act as an agent for investors who want to buy and sell financial securities. The broker actually earns commission and fees for the services that they provide. Up next, you have security dealers, which are financial intermediaries who buy and sell stock, bonds, and other securities for its own account. And their goal is to earn a profit by selling the securities for a higher price than they paid for. Final one is an investment banker, which is a financial intermediary that helps firms issue new securities to raise financial capital. Sometimes by newly issued securities themselves. They buy newly issued securities themselves, but oftentimes they just arrange for the sale of said securities. So that really leads us to regulations of financial markets, right? So if people lose confidence in banks, right, they are likely going to withdraw their funds, which could cause the financial institution to collapse as a whole, similar to what happened in around 2008, where the financial landscape collapsed because the government was essentially handing out money to people it should not have been handing money out to. We want to avoid that, right? Because that was a pretty rough time. You could probably ask friends or even your parents, most likely, how that went down, and it was a pretty rough time all around. So the government came out with some ways to avoid those issues, right? And one of those was through financial regulations. So throughout the 20th century, federal government introduced new laws and regulations in order to overcome or prevent future issues. The result came in the form of the Federal Reserve Act of 1913, which created laws that established the Federal Reserve System as the central bank of the United States. They wanted to centralize the banking, and the law gave primary responsibility to overseeing our nation's banking system, right? It created something called the Fed. However, the Fed didn't actually really resolve all of our issues, right? There were still some issues that occurred in the late 30s. Congress responded in the 30s by passing the Banking Act of 1913, which is a law that established the Federal Deposit Insurance Corporation, or the FDIC, as you've probably heard of them before, to insure bank deposits. Those also prohibited commercial banks from selling insurance or acting as investment banks. Then in 1934, we got the Securities Exchange Act of 1934. I know who would have guessed, which were laws that regulated the trading of previously issued securities. Created the Securities and Exchange Commission, or the SEC, as you probably heard before. It allowed to prosecute individuals and companies that engaged in fraudulent securities or market activities, right? So there was some bringing down the hammer on people who were, engaging in illegal insider trading, right? Obviously, it's not a great thing to let go on. So that brings us to deregulation during the 80s and the 90s, right? So the passage of previous laws ushered in a period of more stable financial markets. But, oh, excuse me, I'm so sorry. So those laws that we just mentioned ushered in some previously ushered in laws, now that I'm back on track, created stability for those financial markets. But some argued that these laws are too much government involvement in private business. People argued that they wanted the government to take a step back. So in the 80s and the 90s, Congress responded to that and eased restrictions on banks and other institutions, claiming that they would be able to sort out the situation to be better for everyone overall. Initially, the private businesses prospered, but eventually everything fell into chaos, which eventually, after some hard financial times, were brought to our modern-day markets. So, investing in financial securities. What are the options out there, right? So, what are some options for investing? First off, we have common stock. You've probably heard of this before. It's a basic form of ownership in a corporation. So, when you own stock, you have certain rights, depending on the stock in the company and how much you have. So, by owning stock, you have voting rights, so it's common for stockholders to have the right to vote on important issues at annual stockholders' meetings. You have the right to dividends, which are dividends and distributions of earnings to the corporation's stockholders. You also have the benefit of capital gains, which is the return on the asset that results when its market price rises above the price the investor paid for it. And preemptive right. If new stock is being issued, right, existing stockholders get to purchase it first. Obviously, big benefit there. Then you have the right to residual claim of assets, which essentially means if the corporation goes out of business, the stockholders have a right to share in the proceeds of selling off all of the assets. So another big benefit there. Up next, we have preferred stock, which is a type of stock that gives its holders preference over common stockholders in terms of dividends and claims on assets. The claim on assets, when holders have the claim on asset that comes before common stockholders is what that means. So essentially, if there's two people, one has preferred stock in a company, another has just common stock, the preferred stock gets preferential treatment. See, that's an easy way to remember it there. On top of that, you have payments of dividends, which are dividends on preferred stock are usually a stated amount, right? They're not just what's left over, like in common stock. So that brings us to bonds. So what is a bond? It's a formal IOU issued by a corporation or government entity. Few basic characteristics you want to know. First off, maturity date, which is the date at which the bond matures. You have par value, the value of a bond at its maturity. You have coupon rate, which is the interest paid on a bond expressed as a percentage of the bond's par value. And you have current yield, which expresses a bond's interest payment as a percent of the bond's current market price rather than par value. Unlike dividends on stock, a firm has a legal obligation to pay interest on bonds to pay the bondholder that par value, right? So there's a legal obligation for that to happen. And when bankruptcy happens, the bankruptcy proceedings usually allow bondholders to recover some of what they owe, but it doesn't guarantee that they'll recover everything that they're owed. Then you have something called convertible securities, which are a little bit more confusing. So first off, what is it? It's a bond or a share of preferred stock that gives its holder the right to exchange it for a stated number of shares of common stock. So a bond or a share of preferred stock that gives its holder the right to exchange it for a stated number of common stock. And it's done through using a conversion ratio, which indicates the number of shares of each security. So essentially, you can convert it just like a convertible. You can put you have the top up or you have the top down, depending on when you want the top down, right? You don't want the top down when it's winter time and 40 degrees out, right? But when it becomes sunny, everything's great, it's better to have the top down. By having or owning these, it allows investors to gain from an increase in the price of common stock while limiting their risk of the price of the stock fall, right? So it's super beneficial that way. And the firm benefits from issuing convertible bonds because the popularity of the conversion feature allows it to offer a lower coupon rate on convertible bonds. Another big win there. Another great one that is fairly well known is something called mutual funds. So, mutual funds are professionally managed investment funds that pools money from many investors to purchase securities. And it has several key features, such as diversification at a relatively low cost. So, by pooling funds of thousands of investors together, mutual funds have the financial resources to invest in broader portfolio of securities, meaning because there's so many people investing into this one specific mutual fund, they're able to invest in lots of different companies, which lowers your risk, which is super great. Another key feature is professional management. You have professional, trained, experienced individuals manning these portfolios. You have variety. Lots of mutual funds have lots of options out there. And liquidity. It's easy to withdraw your funds from a mutual fund. That brings us to personal investing, which I want to get into. So, when you're investing in a personal level, you're going to have to do something called choosing a broker. So, members of the public cannot directly trade stock or other securities in any form. That is where the investor enlists the help of a broker. A few different kinds of brokers. So first off is a discount broker, which is a person that provides basic services needed to buy and sell stocks, mutual funds, exchange traded funds, and bonds. Then you also have full service brokers, which offer a wide range of services such as market research, personalized investment advice, and tax planning, in addition to executing standard trades, right? So just to be clear, when you trade on something called like Acorn or any of those other investment apps on your phone, that's kind of like going through a discount broker, except there is really no broker involved. that still doesn't mean that you are trading the stock yourself. It's just done through an intermediary. So we talk about keeping tabs on the market. There's last two slides I want to talk to you about just briefly. First off, something called stock indices, right? So most common way to track general market condition and trends is to follow various stock indices. A stock index is a statistic that tracks how the prices of a specific set of stock has changed. So two commonly looked at indices are the Dow Jones Industrial Average, or the DJIA, and another very, very commonly used one, you've probably heard this dozens of times throughout your life, is called the Standard & Poor's 500, or the S&P 500. Has a broader index than the DJIA, and in this reading, it includes lots of large, well-established American corporations. So that's why it's probably the most popular version out there that people use. Last slide, talking about tracking the performance of specific securities. So many financial websites offer info on how specific stocks are doing, right? It's as simple as searching the stock symbol on that given website, which is a stock symbol is a short combination of letters that represent the business. And some common pieces of information are shared on these websites, right? So common pieces of information you might see, something called last trade. So when was the last trade? Any changes in the stock? The highest and lowest currently offered bid to buy a stock. Then you have the day's range, is that day's highest and lowest price. The 52-week range, the highest and lowest of the last 52 weeks. Volume, which is number of shares of stock that have been traded up to this point. Market cap, which is the total market value of all shares of the stock. P/E, which is the price to earnings ratio. Or the EPS, which is the earnings per share. And those are some common things you'll see on websites when it comes to tracking for finance. All right, so that is going to bring us to the end of our chapter on financial markets. If you have any questions, please reach out to me and I will be happy to answer them.